Please welcome your panelists for Global Private Equity Outlook, moderated by CNBC reporter Leslie Picker.
All right. Well, on this stage, we've got $600 billion in assets under management combined. My contribution to that is nothing. But that figure is about 12% of the $5 trillion managed by the private markets in its entirety. And that number is up 8% year over year. As Mike Milken recently said, this is private equity's golden age. And private equity will continue to play a growing role in the economy in the years to come. But where do we go from here? That's the big question. With mega funds and trillions in dry powder, some say private equity has reached a peak, but others say secular forces have propelled the industry higher, and its influence will only increase over time. Either way, the pressure is up on these folks and others to keep the good times rolling. And with that, I want to introduce those far more equipped to opine on the subject than myself. Starting with Leon Black, who is the chairman and CEO of Apollo Global Management. Apollo calls itself a contrarian, value-oriented investment manager in private equity credit and real assets with significant distressed investment experience. Apollo's core industry sectors include chemicals, manufacturing, natural resources, consumer retail, business and financial services, leisure, and TMT. And to my right is Bruce Flatt, the CEO of Brookfield Asset Management. Headquartered in Toronto, Brookfield invests in real estate, renewable power, infrastructure, and private equity. The firm says its competitive advantages lie in its scale and global reach, as well as its 115 years of experience. You don't look that old. Robert Smith, the chairman and CEO of Vista Equity Partners. Vista invests in software, data, and technology companies by managing private equity, credit, and public equity market funds. Forbes recently named Smith one of the 100 greatest living minds, along with Mike Milken. And lastly, John Sokoloff, but not least. Managing partner at Leonard Green. Leonard Green primarily focuses on companies in the consumer business and healthcare services space, as well as retail. John sits on the board of directors of many well-known companies like The Container Store, J. Crew, and Shake Shack. So now you get a sense of kind of the diversity of the panelists here today, and half the panel, Leon and Bruce, oversee firms that are diversified, scaled, and publicly traded. The other half, Robert and John, are more specialized and sector-focused and unlisted. They're closely held. So each of you have such different strategies and such different paths that you took within this industry. I want to go one by one to see why you chose the path that you did and why it's worked for you, starting with you, Leon.
Okay. Good afternoon, everyone. Pleasure to be here with you, Leslie, and also all my friends up here on the platform. They are friends. Bruce, you were having dinner with our wives Sunday night. We just had dinner. Robert, we had just had lunch, and John, we go back to Drexel, and John's on our melanoma board, so it's good to be here with good friends. Even more importantly, what I like about this panel is the fact that each of us has a secret sauce to navigate, basically, what is a very challenging private equity world right now. We're sitting, I thought last year was absurd, at 10.5 times EBITDA multiple, and I've heard recently it's now at 12 times. And so everybody says, with all this money and these high prices, how can you make money in private equity? And I think what you have here is a panel of 4 pretty successful strategies to be able to traverse this challenging world out there. There are many roads to Rome, I like to say, and it's well represented here. Our secret sauce is a few things. One, we have always been value investors, which means we like to buy good companies at low prices. Now, a lot of people say that, but we've been able to actually develop multiple pathways over the last 28 years since we started at Apollo to be able to accomplish that in different types of environments. So during the 4 economic downturns that occurred in the last 28 years, we turned our dial to distressed investing, buying good companies basically through their debt when the financial markets were shut. We'd buy the debt at discounts. We'd work with other creditors. We'd end up restructuring the capital structure of those companies and hopefully ending up in control of those companies when it came out of bankruptcy or restructuring. And if we didn't get control, we'd make money on the bonds. What a lot of people don't realize is the entry multiple in that strategy in buying the debt was at about a 5 multiple of EBITDA. So that would be one way. Another way is we deal a lot with complexity. Deals that have a bit of hair on it, deals that are carve-outs on the corporate side, but deals where we could get a proprietary relationship with a seller. We do a lot more of that than most of our peers, and most of that has been done at roughly a 6 multiple. Then we also do look at what we call idiosyncratic buyouts, where we think we can have an edge in an industry. We cover about 9 different industries, some of them in packaging, some of them in insurance, telecom, and there sometimes we meet peers. The first 2 we don't, and in those situations we're at about a 7 multiple. The upshot of all of this is that we have put our portfolios together on the private equity side at about a 6 multiple. You know, last year in that 10.5, 11 environment, our $18 billion fund was deployed at a 5.7 multiple. So not 1 multiple difference or 2 difference, but really half of what our peers are doing. And we've had good results, you know, from that strategy. The other thing that we do is that our firm today is a $250 billion assets under management. Well, 75 of that is private equity, but the biggest part of that and the fastest growing part is credit. So oftentimes you look at the capital structure and decide the best risk reward is at the bottom of the pile, where you want to own the company through the equity. Sometimes it's higher up. And so we buy a lot of debt, and we buy senior debt even, and there are some very good opportunities there also. So our secret sauce is trying to be a fund for all seasons in terms of what we do with the balance sheet, what we do with cycles, but always as a contrarian, trying to buy at low prices very good companies, and the results fall in line. The last thing I'd say about the strategy is that when you buy a portfolio at 5.7 times, it means you're also not levering at 6 times, which is what peers do when they buy something at 10 times. When you buy it at 5.7, it means we're levering it about 3.5 times. So we like that risk reward, and that's what we plan to keep doing.
How about you, Bruce?
So we're on the value side of the
Value diversified,
the value
publicly traded side.
You set us up correctly, so that's good. So our story is we're just under 300 billion in size. We're in 4 businesses: real estate, infrastructure, renewables, and our private equity business revolves around those 3. So it's private investments revolving around those 3 businesses. So we just bought Westinghouse out of bankruptcy. It services utility companies. We knew it because we've been in the power business for a long time. But our sauce is essentially 3 things. We have really 3 competitive advantages. One is scale. With the size of businesses we run, there are often times when there are only a few people that can participate in taking down a transaction. And I would say that just gives us an added advantage in certain situations. Unlike many firms are globalizing, but we've been global a long time. We have businesses in 30 countries. With our 1,200 investment people, we're spread in 100 offices around the world. With 7 main offices, we're in every single relevant market in the world. And what it allows us to do is to take ideas and turn them into actionable opportunities. And often people say India would be a great place to invest right now, or whatever the theme is that month, but it's just not easy to do it if you don't have people in the ground. So we've spent the last 25 years making sure that we had people on the ground and being able to move money in and out of countries, figuring out the tax regimes, and you can only do that if you have scale and size. And third, we have $100 billion of permanent capital in our parent company and 4 traded partnerships, and those enable us to have long-term businesses that we keep forever. So we have 75,000 people that work for those companies. They never leave. They stay with us. They carry a Brookfield card, and they give us just a differentiation when we're buying things. We just can take, instead of just buying an office building, which is fully let, or a company which is working well, we can restructure them and we can work them out. And so those are really, I'd say, the 3 things that we try to, and they're not better or worse than anyone else, they're just different. And I think to Leon's point, there are many, every private equity is a broad term, but there are a lot of different niche strategies within it, but the world is very large. And if you can pick your spots and capitalize on your advantages, there's a lot of money to be made in the long term.
Great.
Yep.
And Robert.
Yes, Leslie, thanks. So I guess we're going to be on the value creation side since it's the value investors side. And what we have done, I like to think about it, and Leon and I had a great lunch the other day. I was trying to describe, we're not just secret sauce, but we create, deep, rich flavor as well, right?
Good thing we all just came from lunch.
We're missing an interesting panel on artificial meat right now, but so we have to make sure they get a little bit of both of those.
Catch up.
So I think one of the keys to what we saw, what we determined, and what we do is that we're at an interesting confluence in the transitions, if you think about it, of the global economy. This idea of ubiquitous computing power has enabled people to think about digitizing their business models. And if you think about the digitization of business models, ubiquity of computing power, connectivity, IoT, all those things, they need software at the end of the day in order to become effective and to actually bring the productivity to those organizations. We, in our portfolio, from time to time, every year, every 6 months, do a survey of our portfolio companies. What's the productivity of the products that we sell to our customers? And it's well over 700%. And if you think about that, the ROI of an average software product that we sell has a return of less than 5 months to the customers. So what that tells you is there's going to be a continued demand for these productive tools. And I always like to say software is the most productive tool introduced in our business economy in the last 50 years and likely will be for the next 50. But the distributors of that software haven't necessarily learned most efficiently how to distribute it, how to manufacture it, how to make it, how to enable their companies to be effective or efficient in their markets. So what we've done is create an ecosystem in Vista that actually enables our executives to be more efficient at what they do. We have an exceptional deal team that goes out, scours the earth for what I call the highest quality mission-critical, business-critical enterprise software companies. We then enable these executives to run their companies more efficiently. That's that deep, rich flavor I'm talking about. And then we focus on what is the second hallmark of a great software company is product superiority. And in our mind, that comes in 2 ways. One, it has to be a process of being able to organically develop those products internally in the organization. And the second is to evaluate a landscape of other products that we can then add to the mix of that platform company and expand our opportunity set. So we like to think about it as really cracking that Rubik's Cube of profitable growth. So in our businesses, we underwrite to a very simple methodology of critical factors for success being under our control. So we're not underwriting to, oh, this is a growth market, let's place a bet and hope that that growth is sustainable. We underwrite the things we know we can change, have changed, and have been successful at changing them. That leads to a very efficient value creation model that gives us opportunities not only on the buy, but opportunities in evaluating how long should we hold these companies, should we recapitalize these companies, should we sell these companies, and then using the balance sheet as a method to enhance returns, not to get returns. And I think those are the key differentiators in terms of a true, what I call, value creation model in what we do.
Great. And John.
Okay, well, thank you for having me. Nice to be here with some good friends. And again, as Leon said, our firms are all quite different and have all managed to thrive in a fiercely competitive private equity world, which just seems to be more competitive every day. So we're, again, a bit different than the other three. We're fundamentally a growth investor. And when you hear that the average multiple may have been 12 times, we're paying 12 times, and we're happy to pay 12 times. And we've been in a relatively low-growth economy, even though expansionary for 8 or 9 years. And we're looking for companies that are growing dramatically faster than the economy. And we've managed to find them. We tend to be consumer-focused. We're multi-location focused. And in some ways, we're looking for companies that are, to use a tech term, disrupting kind of pedestrian industries. So we have a company called Jetro that's disrupting the food service distribution. We're in the car wash business. We're in the body shop business. We're heavy into the fitness business. And we're in the healthcare services business. We have a chain of dental clinics opening 1 new clinic a week. So you can find companies growing dramatically faster than the GDP, and if they are going to double or triple while you own them, you're happy to pay 12 times EBITDA, because in 3 or 4 years, you probably own them at 6 times EBITDA. So that's worked extremely well for us, but it's hard to find. But you do have to have a strong stomach to pay up for them when you find them. The second part of our business is, what do you do once you own them? And private equity firms have dramatically different strategies. In that sense, some people have large armies of consultants and operating partners, and we don't, but we have a fairly effective portfolio service division, and our pitch to these companies is, we help you but don't drive you crazy. And it sounds kind of silly, but it's very important to our secret sauce, because a lot of our peers do drive the companies crazy. So when you're courting a company to make an investment in them, whether it's minority, majority, we tend to buy really high-quality businesses that don't want someone to come in and tell them how they're going to do tell them how to do everything better than they're doing it now. They want someone who's going to be a coach, it's going to help them. We have tremendous resources within our firm to help our businesses. And our hope is to make a good company into a great company. And we hold summits every month voluntarily to be attended by our companies in a different discipline within whether it be transportation, whether it be how to run their website better. So we have a community of companies that's really focused on helping each other grow faster. And if you grow, it's more important the company you do buy than necessarily the multiple that you pay.
Now, with the proliferation of private equity comes kind of larger themes. One of those is, for 20 years, we've seen a decline in the number of publicly traded companies in the US. On the flip side, we've seen a dramatically large increase in the number of companies that are owned by private equity backed and owned as portfolio companies. Now, John, I know this is a topic that's important to you. It's something you've studied. Do you think that 10, 15 years from now, that this will be a good trend?
Well, to repeat this theme, the disruption is an overused word today, but in many ways, I think our industry is disrupting the public equity market model that has been paramount in American economy for 50 years. There's, depending on roughly 8,000 companies in the private equity world. The number of public companies has shrunk in half to about 3,700. The private equity industry employs about half of the people that the S&P 500 employs. So we are a very, very important part of the economy, a growing part of the economy, and our view is that we're a better model. We're a better model for governance. We don't have to deal with all the hassles of the public boards and what's the activist going to say, and what's the ISS going to say, and you go to a public board meeting, it's more form over substance. You go to a private company board meeting, we get right down to the meat of the business, and we help the businesses, and we're involved. So I think it's a pretty dramatic shift that's going on, and the public equity markets are really losing share. Mm-hmm. Now, there's a few giant stocks, so on a market cap, they kind of distort things, but I think our model, many managers love our model. They may be scared of it initially because they don't know about it, but once they learn about it and operate under the model, it's much better. And something else you're seeing a dramatic increase of in our world is our exits are often to other private equity firms. Depending on who you ask, 30 to 40% of our industry is sponsor-to-sponsor transactions, as we call it. And many firms, the most common exit used to be IPO. And many firms just don't want to go public, so a mid-sized firm might buy a company from a small firm, and a large firm might buy a company from a mid-sized firm, and a mega firm might buy. And there was a stigma attached to this 10 or 15 years ago, but I think it's a circle of life in our industries. Our business model, to make our investors happy, we have to sell. Now, sometimes we can hold longer than others, and we just did a report card on our sponsor-to-sponsor deals, and our returns are among the highest in our portfolio. So it's another way that our industry is evolving and keeping the companies in our community. Just like the venture community, companies are going public later or not going public later, because the public markets are a little hostile in some ways, and we believe our form of governance and running our businesses is superior, and we will continue to gain share in the economy.
But on that point, obviously with the greater influence that private equity has had over the economy, do you think that comes with the need for more regulation? I know that's kind of like, what happened on Capitol Hill with Facebook asking a private equity executive for, to opine on having more regulation, but if we can kind of take a step back and think about...
No more regulation.
No more regulation. Anyone feel like there should be more regulation, just given the size of the influence of the industry?
Well, I think the whole issue is a little bit of a moot issue. It's a little bit Einsteinian about matter. What happens when a company goes private? It is private for a while. It doesn't have to report quarter to quarter. Things can get done, as John said, more efficiently. And then there's an exit. Most private equity has a 10-year term to it if it's not permanent capital related. So it then goes public again. So it's really, as John said, a cycle of life issue. It's not like it's all of a sudden staying in some bucket forever. Most of the time it goes public again, or it gets merged into something else. Plus the fact there are a lot of new companies being created all the time. There are build-ups, there are carve-outs, there are spin-offs. This is just one more type of interim vehicle which can make for more efficiency. On the regulation side, there is a little more regulation now. CFIUS clearly is something that we've all become more aware of the last few years. That may, under this administration, be a more expansive regulator for a while, if necessary. But I don't think because it's private equity that militates towards more regulation. It's not like we're doing something totally different than when it's public. We're managing, we have good managements. They're hiring people. If necessary, they're firing people. They're expanding. They're growing businesses, and then they're taking them public again.
Yeah, I think, Leslie, I think the fact of the matter is private equity has just, frankly, a better alignment of incentives between stakeholders, stockholders, management, and the company. The challenge I think that the public markets have run into is that often the managers of those businesses don't actually have a meaningful stake in the companies any longer. And so it's kind of management by the management for the management, right? And the board of directors often aren't necessarily directing those managers to maximize shareholder value for the shareholders, but often it's for the management. And private equity, because we have our own capital, A, in each of these deals, B, we're managing capital that we only make returns personally when we actually return to our stakeholders or our shareholders, which are the public pension funds, et cetera. Our alignment and our incentives are to actually transform these businesses and to make really efficient investments and make those companies operate more efficiently and return value to the shareholders, as opposed to remain as incumbents in management in a company and milk the benefits out for ourselves. So I think that fundamental difference in alignment is why I think, A, the private equity model is going to continue to gain momentum. And oh, by the way, and I know these folks, it's probably some of theirs, when we are providing incentives for our management teams, it is based on a return to our LPs, our investors, not based on how long they stay there or what activities they make that aren't value creating. So I think those are the sorts of alignments that ultimately will continue to move the momentum in the direction of private capital as being the purveyors, again, of these businesses. One other thing in our industry, in the world of software, fact is every software company kind of starts off small, and 98% of the businesses we look at are private. And so they're used to that model, and not because of the cash flow generative nature, they don't necessarily need to go public to get capital to grow. They can create that and also get it from folks like us to actually expand their business and the business opportunities.
And the capital, oh, sorry.
I was going to say, Leslie, that I think two things that are missing out of this discussion is that the size of companies, we say 8,000 down to 3,000 or whatever the number is, or 4,000 companies, but the size of the companies today are just bigger. There's consolidation going on in every industry, so I'm not sure what the numbers are. I'm going to go prove this after this panel.
I've seen both estimates, yeah.
But if you look at the scale of the market caps, they're just bigger today than they were before. So just the size and scale of these businesses are bigger. And secondly, I think that this ebbs and flows in the capital markets. And there has been a period of time when more companies have been going private. There will be when more are going public. We've brought one out of bankruptcy. We did this year. We did an IPO last week, and we took two private, one going private, and one's been taken private. So 4 of those have happened in this year in 4 months. This ebbs and flows in the markets. I think the general trend is, look, everyone in this room knows that private equity. More money is going into private assets globally. There's large money in both high net worth and in institutional clients, and they want to put their money to work, and we can efficiently put it to work for them in private assets. But I don't think that means that the public markets are going away.
But it sounds like you're saying, all of you, that the 5,000 companies that are publicly traded in the U.S., despite their steady decline, will never reach zero.
I would say that's a guarantee.
Okay. Great. Well, speaking of money going into private equity, obviously one of the biggest headlines about private equity in 2017 is the fundraising. 921 private equity funds reached a final close last year, securing more than $453 billion. That's the largest amount of capital raised in a single year. And about $24.7 billion of that was Apollo's fund. Now, Leon, I would love if you could kind of reflect on the process, why people are giving money. What is it that was different about the fundraising round this time than the previous funds that you've raised in the past?
Okay, well, I think you have to understand a few things about private equity. Number one, it's been the best returning asset class for 3 years, for 5 years, for 10 years. That's including real estate, that's including bonds, that's including everything. So one, it's a very good asset class for investors overall. 2, there's an alignment of interest, I think much closer than in any other asset class that I know of. Basically, we, as a GP, get a management fee for Apollo on private equity. It's been about 1.25%, and then we get 20% of the profits. But we only get 20% of the profits after our LPs have an 8% minimum return. And 2, when we do get it, we give back the management fee. So, and we are invested alongside them, our LPs, with a lot of capital. So 1, it's the best returning asset class out there and has been for many years. 2, there is real alignment of interest. Now, what has happened recently? What's happened recently is that the world is awash in capital with low interest rates and with the central banks carrying on the policies that they have. There is a huge amount of capital out there, and it's looking for return. And so that combination has really opened the floodgates in terms of fundraising. There's one big difference that's happened in the last 5 years, is that a lot of the LPs have also wised up. They've hitherto had very, very large portfolios of as many as hundreds of GPs that they invested in. They've had the opportunity over the last 10 years to see which have been successful, which have been less successful, and they have made decisions to try to have more rational portfolios where they're giving more to the winners and less to the losers, which makes eminent sense. Basically, we were fortunate to have a history of being a winner in terms of having good returns in previous funds. Our strategy that I described in terms of being a value investor has paid off to our investors. And so we were fortunate to be hitting this trend of a lot of capital around, a lot of LPs looking for places to put it, wanting good returns, and so of course they're going to go with those that have given it to them with their strategies, and if they have retained their teams that have been able to produce those returns, and that's where we are.
Now, McKinsey estimates that dry powder right now is sitting at about $1.8 trillion, and it's grown about 10% every year since 2012, but as a percentage of AUM, it remains steady around 32% or so. But if this trend continues, and especially when you add leverage into the equation, I'm curious, Bruce, what this means for your own deployment of cash in terms of sourcing deals. Do you sit out on the sidelines? Do you wait for better pricing? Or do you try and find opportunities where they might persist?
Look, I'd say on balance, in 2009, if you were a U.S. institution, you should have put every possible dollar you could find to work. Today, you should be a little more conservative. So we are being a little more conservative than we were being in 2009, merely because in 2009, anything you could possibly buy, you knew was going to be a three-bagger within a short period of time if the world reverted itself. Today, and that's not to say that the world is, we see any issues out there, but we're just being a little more conservative and making sure that we find our spots. And what that means for us, again, we have a different strategy than many, is in the developed markets, we put more of our people and they go do hard work. Mm-hmm. You can still, amazingly, even in this environment, you can still find companies in bankruptcy. People actually, things happen and they put companies in bankruptcy and you can buy them out of bankruptcy. And third, and because of our global business, there's a lot of places in the world that don't operate at the same capital system or same environment as what the United States does. So when we talk about capital markets and money flowing around, we generally think about the United States when we sit in the United States, but we put $12 billion into Brazil across all of our businesses in the last 24 months, and there were very few people putting any money into Brazil. And most people didn't have the capability to do it, but the point is, if you did, there was lots of opportunity. India today offers lots of opportunity. So you just have to, for us anyway, you just have to find your spots.
Now, I'd love to hear the perspective from the more growth side of the panel. Because in recent years, LPs who were surveyed, 88% of them said that they consider valuations to be the greatest challenge facing the PE industry. I think the multiple was about 11.2 times on average in Q3. That's according to Bain for buyout purchase price. Investors I talk to are expecting that alpha will naturally diminish over time. But Robert, I'm curious what you do in this environment, given that tech may be an area where you're kind of used to higher multiples, but one where I think people are looking at and wondering when that tide would turn.
Sure, there's a couple dynamics in our market that you have to take into account as you think about investing. One is, every industry is literally going through what we call this fourth industrial revolution. There's a transition to a more digital-based economy and the engagement of how companies are engaging with each other and how they're engaging with their consumers. As a result of that, software, the world that we live in, is in a high demand across every industry because it has high productivity and capabilities that will determine, in some cases, winners or losers in those industries. So some of the companies that end up bankrupt is because they haven't embraced the digital economy fast enough, and they've lost touch with all of their customers. And you can kind of look at the retail sector, which is littered with a number of companies who did not make that transition. So that's one effect that you have to take into account as it relates to enterprise software. As you think about multiples in the world that we live in and how we underwrite in particular, it's, again, things that we know we can control. And part of it is, what is that business worth to us? When we implement and work with our companies and implement these best practices, reinvigorate the revenue growth, and create the efficiency in those businesses, is that really an 11 times multiple? Are we owning that thing at 4 times? You see the point? And so to a great degree, we look at what are the actual investments that we need to make and are making, and are those investments going to help us expand the opportunity set in a marketplace that, frankly, will have, in some cases, one determinant winner or one set of determinant winners in that industry. And so you have to take advantage of that opportunity, because once you have that customer set, you often have those customers for decades. And I always use the opportunity to say, okay, you can look back and say, well, where does that really work? You look at the spreadsheet business, and everybody in this room uses one spreadsheet, unless there's some people here from Google, okay? And so if you think about it, to a great extent, that's how a lot of these industries in our market evolve. There will be one winner that takes the lion's share of the economic rent for that product because it is the superior product and it delivers superior returns to its customer sets. And that's what enterprise software customers look for. So our model is really designed around how do we build the most efficient and effective products at the lowest cost and delivering at the broadest level to all of our customer sets in our company. So to some degree, we're not bound by what I look at, what are traditional multiples? What we're bound by is what, in fact, does this business deliver to its customer base, and what is the competitive dynamic in that end market? That's what we focus on.
So more of a winner takes all.
And that is the nature of enterprise software. And so from our perspective, we need to create those winners or buy the companies that are the winners in that space and help them ensure that they maintain that leadership not for quarters or for years, but for decades. And I think when we get back to the public market challenge, the problem is our public markets continue to look at quarterly as the measure of success, as opposed to having the superior products which you can then deliver to your customers for decades. And that's really that gap in perspective is what creates opportunities for us in the marketplace for enterprise software.
Leslie, I would say I've now been with Apollo since it started in 28 years, and I don't think there's a fund that we've raised where people haven't said, there's so much money around, how are you going to find a way to invest this? And that has happened fund after fund after fund. And, in 28 years, we've had a net return of 25% to our investors, about 2.5x. And Robert can't talk about it because he's in registration right now, but he's done even better than that. And I'm sure Bruce is going to make even more than that in Brazil with that $12 billion. So the fact of the matter is there are niches. You can't just go by the averages out there. And the fact that there's 1.8 trillion is irrelevant. It really comes down to what is your strategy, what is your niche, what is your team, and whether or not you're going to be able to perform in the future there in terms of who your competition is. We don't see each other on a competitive basis. Just about, I'd say 95%.
Right.
I don't see KKR or Blackstone or Bain in terms of what I'm doing out there. So the aggregate numbers really don't matter that much. Your particular strategy and your team is what does matter.
Yeah.
Look, it's a time of high anxiety among, say, our limited partners. Part of it is because they've been so successful. Everyone's been very flush. Returns have been extremely strong for 7, 8, 9 years now, and that's when people just kind of worry, oh my gosh, how long can the good times continue? Also, our business, we are money managers. We're driven by the asset allocation model at our limited partners. they say 10% is going to go in private equity. Well, guess what? Last year, the stock market was up over 20%, so the denominator went up 20%. A few years ago, the stock market was up 30%, so they have to deploy more money into different sectors to rebalance their portfolio. So everything's been going up, so we never worry about the dry powder of this. We worry about what we know how to do, and all of us on this panel do one thing and try to do it well. Now, if you want to get worried, our returns have been terrific, and they're probably better than they should be because we've benefited the past few years from multiple expansion. We buy something at 8 times, we sell it at 10 times. We buy something at 10 times, we sell it at 12 times. You worry how long that can continue, and we might all now have to have some multiple contraction. So the only way we feel we can invest with that risk is find growth. So for example, in our Fund 6 portfolio, the 4-year average historical EBITDA growth rate of companies we bought was 12.5%. In the fund we're currently investing, the 4-year historical EBITDA growth rate is 19%. So if we can grow 19%, and by the way, when we do 19 historically, we then re-underwrite, we reduce that, so we kind of have a 15% projected EBITDA, which means you double over about 5 years. So if you double over 5 years, and even if you pay 12 times and exit at 10 times, the model works. So again, focus on the numbers, do what you do well, stick to your knitting, but you have to evolve to meet the market realities of today. The market of today is very different than the market of 2008 or 9, where we all pivoted and evolved and took advantage of the opportunities that the capital markets gave us at that time. But you can't predict the future. All the folks on this panel have shown is whatever twists and turns the market brings, we've shown an ability to evolve and adapt and pivot and deploy our investors' capital and continue to deliver the strongest returns in the investment community, which is why the money's flowing in. And the other thing I'll say about the money is a little different, is the money is much more global now. So 10 years ago, we might have had 15 or 20% of our investor base being international, and today it's 50%, and we may be lower than some of the folks on this table. And there's new pockets of sovereign money opening up constantly in Asia, in the Middle East, all over the world, where people are flocking to America, which is the stablest and best economy. Our returns have been strong, so there's a lot of new players coming into this space because the returns have been great.
So LPs who are concerned about kind of the reversion to the mean, in terms of performance, do they have nothing to worry about?
The only other point I'd make is the big and the entities that have good returns keep getting more and more capital. And the institutions globally, and many in this room know this, they get larger and larger, and they just can't spend the time to put $50 million into a fund. It needs to be 100 or 200 or 500 or more. And it's that scale that gives them the ability to have to, when they have a $500 billion fund, it's just not efficient they can't take the time to go to a $50 million manager. So to the point, the big just getting bigger, and I think if you had 3 small-sized firms up here, the story of fundraising would not be the same. There's a big difference out there in fundraising.
Yeah, I think Leon hit exactly right. A number of LPs that we are engaging with are all going through their own rationalization. Over the last 10, 15 years, they said, okay, let's try a number of firms. They looked at how they performed over the last 10 years, and now they're saying, I'm going from 80 managers to 20, or 300 managers down to 70, or something of that sort. And I think that dynamic is going to just naturally concentrate the fact that A, they have more capital because they've been returning quite well, and B, it's going to fewer people. But there's another dynamic that's interesting, which is what I call the alignment on the LP side of the fence, okay? And so some of them have got it exactly right, where there's an alignment for long-term investing with, great GPs and how they're managing their capital. And they're paying their people to make long-term decisions for their pensioners. But some don't necessarily have that correct. And I think that's one of the areas that we're going to see, frankly, some reform over a period of time. Because if you are managing massive pools of capital and you're incenting them on short-term returns, then they're not necessarily going to go to the best funds long-term for your shareholders. They may look for ones that are capturing, I'll call it, short-term volatility opportunities in that fund set. So I think that's a dynamic we're going to have to keep an eye out for. with the LP community, because that's another alignment issue that exists in the marketplace that some have got it right and some need to work on it.
Let me say one more. In our sector, the first decision you have to make is, do you want to invest in private equity? And let's say you make a decision, 10% of your portfolio. In many ways, the more important decision then is which managers to choose. And there's a dramatically wider dispersion of performance in our industry, I think, than in many other asset classes. And when you can look at averages, we've outperformed the S&P by 500 basis points, whatever. For top quartile firms, it could be 1,000 or 1,500 basis points outperformance. So manager selection is so crucial in our industry, which is why many of the LPs are reducing the number of relationships they have and focusing on their winners and doubling down on their winners. And hopefully you're in that small group, and then you're happy.
Now, I'm curious within the retail and consumer space in particular. Recently, it's taken some flack. It's taken some blame for a lot of the bankruptcies that we've been seeing in that space. Do you, as an expert in retail and consumer, do you think that blame is warranted? Do you think that there's another side to the story?
Well, I think the retail community has been and will continue to be in dramatic change and turmoil. And it's been a treacherous space to invest in the past. We had a great run in retail. For many years, we were kind of known as the retail firm. Many people still think we're the retail firm, and those are folks that haven't kept up with us, because 5 or 10 years ago, half of our portfolio was retail, and today it's closer to 10%. It's, the internet has come, and e-commerce and Amazon has turned the world upside down. There's still a bunch of retailers that are thriving. Look at Home Depot, look at TJ Maxx, look at Ulta, look at, there's a bunch that are doing well, but in the end, the winner from the Darwinian change in that space is the consumer. Consumers getting things faster, cheaper, when they want them, how they want them. But it's still an exciting space. Look, if you figure companies like Walmart and Target, you think they'd be out of business by now. They're still actually growing, amidst the craziness. They're at the Century City Mall next door to the hotel here, which just underwent an $800 million renovation. 15 stores there started as online-only retailers and never made any money. And now they're opening up retail outlets, and those outlets are making money. So the omni-channel evolution of the business is here, and that's probably what will save those companies and make them profitable.
But a lot of those companies you mentioned, whether it's Home Depot or Walmart, they're not actually owned by private equity. So when it comes to the blame that the industry has given, I think they look at a lot of the companies that were private equity backed. Do you think that there's a correlation there? Or do you think that it's more just a factor of kind of the size and where they were in their cycle?
Well, if you levered up a company heavily and then were dramatically disrupted by some competitive dynamics and your profitability collapsed, you didn't make it. And in that case, the debt was a problem, and you made a mistake, you made a bad deal, you made a bad decision, and there certainly were some of those. In some of those situations, it wasn't really the debt that killed the company, it was just the changing world that killed the company. And because it's easy to fix the balance sheet, you can just turn debt into equity by the slice of a pen, and we've all done that as well. But that doesn't help the underlying business, and even with those restructurings, some of these businesses haven't made it because the world has changed, they didn't change, and they are a casualty.
No, I'm curious, as a lot of the companies that you all invest in are getting disrupted, and that's been a common theme. I'm curious how technology has impacted the alternative assets industry, and how you all are using technology, whether it's from data sourcing in an operations capacity to improve the businesses that you run. A natural place to start would be with you, Robert.
Sure. I mean, they're basic, call it, it's kind of CRM or customer relationship management tools that we use to source. And we always tease some of our LPs that we actively manage and cultivate over 800 investment banking and broker relationships. And I said, you probably couldn't name 50 if I paid you $1,000 to figure it out. But we cultivate 800 in a reverse solicitation fashion, because we want to use our systems to ensure that we have the greatest coverage in this ever-expanding market that is software. There's over 90,000 software companies. Well, how in the heck can you cover them in a retail model? You can't. You have to go wholesale. So we rely on partners to enable us to have visibility into how those markets are actually performing in terms of what companies are interesting, which ones should we keep an eye out on. We also use another, I'll call it, set of tools, which are at the portfolio company level, which is how do we identify add-on acquisitions and do a screening against those to evaluate, do they make sense for us to think about evaluating. So from our perspective, technology is just frankly part of the whole fabric of what is Vista in that context, in addition to evaluating what I call the data that artisans out of each one of our portfolio companies. Those are the ways that we remain informed in our business on the one hand, and frankly, because I have 50 CTOs, we've got 50 of the smartest people who are in specific industries who inform our teams as to what we need to be thinking about, what are the changes in either the tech stack or a product dynamic or something that's happening in a particular industry as it relates to some technology that's being developed that informs our whole ecosystem and community. So again, we don't think about using technology. Technology is just part of our whole fabric, and that's really the way that we approach it.
Do you all feel the same way? Have you seen a greater utilization of technology within the alternative asset industry over time?
I would just say that, just remember, we operate businesses. That's all we do. We buy businesses and we operate them, and every business today is undergoing great technology change or using technology to advance everything that's in place. And that's changing all of our businesses. So every one of us, I'm positive, has each of the businesses and up top in the overall business is using more technology today than ever, and will continue to do that. It's a very important thing for the business.
Now, since this is the global conference and this is the global private equity panel, I think I'd be remiss to not ask about one common region that I keep hearing about with regard to private equity, and that is Asia, both from a deal-making perspective, from a fundraising perspective. And Bruce, you recently told Forbes that you believe that in 35 years, half of the global GDP will be in Asia, and half of it will be in the Western economy, making Asia a great place to invest. What are some of the hurdles that have been lifted that has created this change to invest in Asia, and what are some of the ones that still remain?
So the one good thing is if you say 35 years out, nobody can ever get you.
No one can hold you to it.
But here's what I'd say. We've always believed China and Asia in particular, in India and China, let's call it, it's 2.5 billion people today. It's growing the fastest anywhere. It's going to be very meaningful to the world in many, many ways. We have we've always had a number of outstanding partners. We went to Asia 15 years ago. We've methodically built up our businesses. We have 15% of our assets there today. And in the longer term, it will be, if companies or entities, managers are set up to be able to do it, and that's their thing, it will be very meaningful to the global business and to asset managers. So we keep methodically building it out, our offices all through Asia, and I think there will be great transactions. It's tougher today than you'd find in the United States, just because rule of law, governance, and other things, depending on country to country. But it gets easier every year, and we learn more every year.
I would say that 75% of what we do at Apollo, and that's in private equity and credit and insurance, is in the U.S. About 20% is in Europe, and 5% is other today. It's very hard for us as a value investor to be doing things in a lot of Asia right now, because the prices are very high, and in many of those countries, you can't have control of the businesses, and we are control freaks. And having said that, I also believe the facts are that 2/3 of the world's population is Asian, so you ignore them at your peril. Right. Clearly, as John was saying earlier, a big part of the fundraising world today is coming from Asia, especially from the sovereigns. That is something we take advantage of, but it's you have to know where you can be smart money. Do they need your capital in a lot of these countries? We have a great joint venture with ICICI in India, looking more at stress things, which is up our alley, as opposed to growth opportunities. That's been a good business, but a complex one. But I think for us, we'll have to move very slowly and selectively in Asia in terms of putting capital there. But as trade routes change, that will change too.
I guess one of the things that we do, we have to remain informed in the world of technology, and because, again, of the ubiquity of computing power, technology is being developed everywhere. And it's a matter of finding it, evaluating its capabilities, its global extensibility is an important part of how we think about it. So to give you an example, 55,000 plus employees worldwide, we have about 10,000 of those in Asia, call it 7,000 or so in India, and the balance in China, Hong Kong, and on the peninsulas, et cetera. But so from our perspective, it's important to maintain intellectual property knowledge. And I like to actually think about it as I actually think fintech's going to be led out of Asia. They have some of the more innovative fintech companies coming out of parts of China that we've seen, frankly, on the planet. And there's a bunch of intelligent people with some great university systems and structures that enable them to develop efficient code that can fit global markets and local markets. We announced a joint venture with McKinsey in Hong Kong on fintech with one of our companies, Finastra, and in the 5 months that we've had that announced, there's been over 300 fintech companies that have come to that joint venture environment that we get a chance to evaluate. To Leon's point, we can't buy those as buyouts yet, but it informs us in terms of where the technology is, where it's going, does it belong a part of our platform, or should we think about creative ways to invest in those platforms that then will be sold back into China. So, we have established a One Vista in Asia, One Vista in Europe strategy, which aggregates the companies that would sell products in those areas, and at strategic levels think about how we can enable those companies to be more effective selling their products into those institutions, obviously, producing higher revenues and profitability, et cetera, but also informing us as to how we need to think about how some of these technologies will inform product development cycles in other parts of the world. It cannot be ignored. You have to think about it strategically, but it's not one that I'm ready to stick 100 people on the ground and see them kind of washed up against the shore, because we can't affect our strategy that we have been very effective at today there. So we have to think about the right way to do it, and we think we have that model figured out at this point.
And John, do you think on the fundraising side that it's becoming more global?
Dramatically. It's incredible, as I mentioned earlier. The sovereigns leading the charge, Australians very active, Middle East very active. But just on Asia for a minute, we're probably the wrong firm to comment on it because we don't have that much there. But we had a couple things. We just exited our first successful investment, our first investment in Asia. But it was interesting how we did it. We did it with a minority position with a local partner in Hong Kong that we had known for many years that we totally trusted, in a space we knew well, in the fitness and yoga space. And we felt that part of the world was 10 or 15 years behind America in embracing paying for high-end fitness and yoga studios. It's growing like a weed. It's opening in mainland China, and we had a very successful exit. But we were not comfortable doing that without that local partner. As we sit here today, Shake Shack is opening their first store today in Hong Kong at the IFC, and they had staggeringly successful openings in the last year in Korea and the year before in Japan. So we're fairly in touch with the Asian consumer, and some of our U.S. businesses are finding great receptivity in opening operations in Asia, often with a local partner.
I just saw that one in Japan. And to wrap up on a food-oriented note, like we started with, I just want to thank you all so much for taking the time and providing your insights here. Really great comments.
Thank you, Leslie.
So.